Eric, welcome back. How are you, buddy?
Hello, hello. How are you?
Good. So why don't we just address the big event today? I know you're not a predictor of what the Fed would do, but what do you think about what might happen, what might not happen today with the Fed?
Um, I don't have a real strong opinion on what they're going to do at this particular meeting. I would say that the consensus
Yeah.
is that they're probably going to speed up the pace of this taper
Okay.
program. I would say that that would be the consensus opinion. But
Want to
the
share your screen,
backdrop,
buddy?
yeah,
If you
yeah,
brought some
sure,
stuff for us. Okay.
always.
So it's difficult to know what to expect.
Can you see this?
Paul, in fact, I think it was one of our attendees said that there was a rate hike in December, and you're right, Saab. It was Powell, I think, his first year in, and then he's saying Kumbaya with Bernanke and Yellen and reversed. So, okay, so uh, uh, the taper in front of what you've been talking about, Eric, for months now about the weakening of the real economy, whatever that is defined as now. Um, in fact, you know what?
It's
Can I
defined
ask?
by exactly these four indicators on the screen right here.
Yeah. Can you explain one thing to me,
Sure thing.
though, Eric? How did we go from massive unemployment to where there had to be support for people and airlines and workers, tens of millions and people that were going to be evicted. So there was a moratorium for them not to be, to having a labor shortage in less than a year. How did we go from having the biggest unemployment problem since the Great Depression, to having a labor shortage now?
Well, that's the question on everybody's mind. I would say that the labor shortages are localized to certain sectors. And I'm not a microeconomist, so I can't speak to why there
Okay.
are shortages in the trucking sector as opposed to the restaurant sector, but I can make a couple general comments. One is there is some evidence that there was a large percentage of early retirements, which
Okay.
knocked some people out of the labor force. Um, the second thing is we had huge behavioral shift in the way that work is done in this country with virtual
Yeah.
work and just a lot of structural changes. And I would also add that there's some government policies that are creating some of the shortages as well. So, for example, and again, I'm not a microeconomist, but here's just some data: is that daycare
Yeah.
services are a big issue with parents unable to find daycare for their kids. And if parents can't find daycare for their kids, then one parent has to stay home at least, which prevents them from re-entering the labor force. Um, there are government regulations around daycare in terms of the number of children that are allowed to be watched per supervisor.
Okay.
I don't
Yeah.
recall the exact number, but let me make up a number and say it's like 10 to 1, right?
Again, a labor shortage that's creating more of a labor shortage.
So the problem is that average hourly earnings in the daycare sector, if my memory serves me, were about $15 an hour on average, which means that you can make more money working just about anywhere else because the leisure and hospitality sector was about $17.50 an hour, and the restaurant sector was about $18 an hour. So why take a job as a daycare supervisor when you can go work at a restaurant or go work at a hotel? You can make more money doing so. And as a result, there are less and less people working in daycare. If you look at the jobs in the daycare sector, they've really fallen off. And that's creating a huge squeeze because of this government regulation around how many children are allowed to be there per daycare supervisor.
Therefore, women leaving the workforce to be mothers.
Bingo.
Okay.
So that's one factor contributing to the labor shortage. The second factor, in my opinion, that's contributing to the labor shortage is that we're seeing wage increases, but we're seeing them in nominal terms. Wages in real terms are outright declining based on some measures. And you can see in the bottom right-hand corner, real income is only growing at 0.5%. This is a 6-month growth rate. So we're seeing consumer prices rise 6, 7, 8%, and everyone's citing these great wage gains of 4, 5, 6. But why would someone take a job to fall behind? So that is my quick 2 cents from a macro standpoint. But then again, I'm not a microeconomist.
Okay, so let's get to what you're seeing here with the charts. We're getting a little bounce in industrial production. Just a temporary blip to the upside, Eric?
Yep, that's right. Because the industrial production, there's been a lot of ebbs and flows because of the starts and stops of the auto sector. So there was a big drop there in March from 8.8% to 3.1, then a pop up, and then we've had a cyclical decline. And then the increase from in this last month here is, again, these starts and stops of these auto sector. There's been some strikes. There's been semiconductor shortages. The month to month numbers are not what's important. It's the overall trend that's important. And I highlighted the peak on all of these, and they all happen to coincide at roughly the same time. And what I do, and again, the reason that this is important is because this is not an opinion. This is not a subjective opinion of what's going on with the economy. These are what I call the 4 corners of the economy. Every economy in the world, whether it's China, Germany, Japan, they all have production, employment, consumption, and income. Those are the gears that make an economy turn. So you take the most reliable measure from the 4 corners of the economy, and this is what comprises the cyclical trends. And I smash these 4 together to create a composite to show what's really going on. And you can see here, when you take them together, we had the growth rate in the economy. I pointed this out the last several times I was on the show. It was increasing throughout the end of 2020. We hit a peak in March, and we've been in a cyclical slowdown since then. And again, that 1 month pop is not important. It's the cyclical trend. That's what's important. So the Federal Reserve over the last several months has been incrementally tightening into slowing economic growth. And it's not the level of growth that's important. People will sit there and say 3.8, hey, that's good. Good is an opinion. Slowing is a fact. So slowing or directional changes are what's important here. And we're in a slowing growth environment, and the Fed is incrementally tightening policy. And the response in the markets to that has been a US dollar that's screaming and a yield curve that's been flattening. Those are 2 textbook signals of tightening policy into slowing growth. And I would make one more point that this is, as it shows at the top, this is a coincident index. That means that this is going to move in a coincident fashion to the economy. This is not a leading indicator. So this is not going to tell us what's going to happen over the next couple of months. This is just telling us what's been happening. And we've been in a slowing environment. To find out where we're going, we need leading economic indicators. And that's one of the things that I produce on a monthly basis is leading economic indicators. And those leading indicators
you're a very insightful guy, Eric.
Thank you, Dale.
But Paul probably has the same knowledge base of what you just showed us before. How can he rationalize ending, additional liquidity and even talking about tightening with the slower growth that you've just,
it's a great point
to us.
One is that they use flawed models at the Fed. They have they still rely on the Phillips curve, which suggests that low unemployment brings higher inflation. That's been debunked almost as much as 30 years ago, yet they still use that model. And then the second thing is what I was alluding to right at the end there was I use leading economic indicators with a cyclical framework. So these leading indicators will tell us where we're going. And the problem with the Fed is they don't use a cyclical framework. They use what we would call like linear extrapolation models. So extrapolating what's been happening and just a linear basis going forward. So what happens is when the economy, and I'm not sure if you can see my cursor here, when the
Got it.
economy is right here at a cyclical peak, I have leading indicators that are telling me we're moving this way, we're moving down, but they're taking these linear models and saying, hey, this is pretty good. It's going to keep going like this. The second thing is that their dual mandate, as much as you believe that they follow it, is unemployment and inflation. Unemployment and inflation are both lagging economic indicators. So by design, they're going to miss every cyclical inflection point. And they're always going to tighten policy at the worst possible time because they're gonna stay easy. Unemployment's going to get low, inflation's going to start to heat up. The cyclical indicators are moving lower, and they're saying we have to respond to that pressure. So they follow, or their dual mandate is structured around lagging indicators. So it's a flawed design.
Okay, interesting. Curious as to why. And are there many other people that agree with you that they're using all these flawed indicators at the Fed, and perhaps that's why they misjudged
Well,
inflationary pressures that
I
ended up
think that
happening?
if you look since 2010, they produced forecasts for growth and inflation. And if we just talk about growth, they've missed the forecast on growth 100% of the time.
That's
And
consistent.
it's always been an upside miss. So they're always estimating that growth is too high. And I think that most people at this point realize that they can't really forecast their way out of a paper bag, which is why they seem to rely on the stock market for their forecast these days. It's more of a, you could say that that they have a third mandate, which is the stock market, but I believe that they've had such a poor track record of forecasting these changes in the economy that they've sort of gotten out of the forecasting business. They still produce these numbers because they have to, but they just look at the stock market, not because, you could say that they're doing it in a nefarious way, that they're really trying to prop the market up. I really believe that when the stock market's going up, they believe that that means the economy is doing well. And when the stock market starts to tank, that means that the economy is doing poorly. And that's the best forecast that they could possibly come up with. So I think
Interesting.
that's where they're at. I think a lot.
Reminds me of Peter Bookvar's statement that the Fed is not data dependent; they're S&P dependent.
Yeah, and it could be because they're focused on this wealth effect or
Right.
other, which is another flawed concept, really. But it's yeah, they're not great at forecasting. They always miss these estimates
But
100% of the time, and always to the optimistic side.
what are your leading indicators saying, if you're
So
going to share that with us?
sure thing. Let me just scroll to a couple here. I didn't exactly know what we were talking about, so I brought my master chart
No,
book, which
no
has
guest ever.
got
You know why no
a couple
guest
of
no.
hundred slides
You know
here.
why no guest ever knows what we're going to be talking about? Because I don't.
So yeah, so this is what we would call so in my framework, what I just showed were coincident economic indicators. And to get an idea
Yeah.
of where we're going, we need to look at leading economic indicators.
Okay.
Leading economic indicators we can break into two buckets: long leading indicators and short leading indicators. Long leading indicators, as the name suggests, would give you a longer indication of where things are headed, something like a 6 to 12 month lead, while shorter leading indicators will give you an indication on a shorter basis, as the name says. So something in the range of 3 months. So commodity price growth is a short leading indicator. And again, we're looking at the growth rate of commodity prices, not the outright level. And I don't like to look at what I would call exchange traded commodities like oil and copper, because they're so heavily speculated on with futures contracts that the price signals can be quite erratic.
Distorted.
OPEC is involved in the oil market, and there's just so much active trading.
Yeah.
This is a basket of 22 commodities. It's produced by the Commodity Research Bureau. It dates back to I think the 1960s, when they were commissioned to produce a basket of 22 highly sensitive commodities that are sensitive to changes in economic conditions. And I put the commodities in that little box there. So you have things like burlap, rubber, tallow. Nobody's really speculating on wool tops that I know of.
Or lard.
Or lard, but these are all things that are extremely important to economic activity. And the growth rate of these industrial commodities was rising at a 50% annualized rate back in April, and they've come down pretty substantially to the point where we're only growing at about 14% over the last couple of months. So the fact that the commodity price growth continues to ebb is a short leading indicator that we don't have a ton of pressure going on in the economy right now. We're sort of losing steam. And of these 22 commodities, you can actually, if I can find it here, you can break it down into the industrial components. Okay. So they have a smaller subset of industrial components. And you can see that this peaked back in February, prior to the peak in those coincident indicators that I was showing. Industrial-based commodities were rising at a 46% annualized rate. They've dropped pretty substantially. And if you look on a shorter term basis, they're actually outright declining. So these would be two short leading indicators that suggest that there's no immediate signs that we're going to turn higher in the next couple of months. I've been on the show saying that we're in the middle of a cyclical slowdown. And today, as we were speaking, the retail sales number came out. And I'm not sure if your viewers were able to see that, but it was a pretty ugly number, Dale.
And it was it for November?
It was for November. So the estimate was for, and let me go back here to, and just please shut me up if I'm going too far. So if we look here at real income is the most important thing for consumption. So we have a situation where real income is rising at 0.5%, but real consumption is rising at 6%. How does that happen? Right? That's an unsustainable trend.
Credit cards.
There you go. So that's unsustainable. And retail sales were expected to come in at 0.9% on a month-on-month basis. Yeah. But not many people know this. Retail sales is a nominal price series. And the CPI for November was 0.8. So that means that in real terms, we were only expecting retail sales to rise 0.1%. Yeah. Retail sales came in, Dale, at 0.3. Again, on a nominal basis, which means that real retail sales were at least negative 0.5%. Very in line with the fact that real income is falling dramatically. So
because people have to decide between Christmas presents and groceries.
There you go. And once
gas and everything.
And putting it on a credit card is difficult to carry. So this real consumption number as a result of that retail sales is going, I haven't updated it, obviously, it just came out, but that's going to tick down very substantially. So this pop that we saw is going to be totally reversed. We're going to be down here by the time this retail sales number comes out.
And that included Black Friday, which was a real day again this year. And that includes all the online buying and purchasing too. What a crappy month.
Exactly. And let me see if I could share this. And so do you see this Atlanta Fed here?
Yeah.
So this is the Atlanta Fed number. Everyone was touting this Q4 GDP number at 8.7%, right? Quite a miracle. I was on record saying that this was going to be a head fake because of those leading indicators that I was showing. We were estimating or baked into these assumptions. This is growth rates by the different categories. The estimate was that real consumption was going to rise 8.6% for Q4. Yeah. We just got a horrible number. So when this gets updated later this afternoon, this 8.7 number is going to get whacked way down.
Yeah.
We were negative in that month and we're up at 8.6. So we could see 200, 300 basis.
They're always trying to be optimistic, aren't they, Eric?
They always miss it to the upside.
Yeah. I wonder why.
There you go.
Yeah. Okay, well, God, what a way to wrap up the year. Consumer tapped, not even spending much for Christmas. Do you expect any kind of rebound in December from
No.
November
So
numbers?
the leading indicators that I see, again, I have the long leading that could see out a little bit further and the short leading. There's nothing that I see that would show a Q1 rebound yet. And going back to that credit card situation, this is more of a longer term trend here. This is consumer debt to GDP.
Okay, we don't see it. We just see a blank screen right now.
Oops, let me
Get the share screen. Consumer debt.
consumer
Wow.
debt to GDP. This is student loans, credit card loans, and auto loans. So while it's very, very true that household debt has fallen since the great financial crisis, which is a good thing, all
Yeah.
of the deleveraging has been in 1 to 4 family mortgage debt. Again, that's a good thing. Mortgage debt was too high. But part of the reason that we're not able, that consumers aren't carrying as much mortgage debt is because they are carrying more student credit card and auto loan debt than ever before. And this is updated as of Q3. And I would argue, as I think most people would, that consumer debt's more onerous than mortgage debt.
Yeah, higher
So
rates.
higher rates, and it's generally a depreciating asset versus an appreciating asset.
Great point.
An auto
Till
loan is,
next year.
well, actually, a caveat is that a lot of people could get bailed out of their auto loans now because the price has doubled. But
That's
I
true.
would I would think that that's an
That's the first
anomaly
time in my
versus,
lifetime, and I'm not that young,
yeah,
that
right.
I've ever
So
seen. There's so many um, events in the economy that I think, maybe it was like that 100 years ago in the last pandemic. I doubt it, but that are just like, I feel like I'm living in the Twilight Zone.
yeah, exactly. So um,
That's
you
why we
know,
need guys like you, Eric. You're young. You didn't experience too many of, how normal, regularly abnormal, normal times. This is really. Uh, do you buy into? I have Forex Gal talking about the Great Reset. Have you done any research? Everyone's talking about this could be a great reset. New currency regime, and um, you know, maybe a debt jubilee. Um,
mm,
do you know anything about the Great Reset?
well, I've certainly heard about it. I'm not
Yeah,
exactly
that's
sure
me
what
too.
what it entails.
Yeah, I have
Um,
no idea.
I would say that a debt jubilee is a fantasy. There's really no way that that could be accomplished.
You will
Um,
own nothing and like it, is what Kevin's saying.
I mean, everyone's debt is somebody else's asset.
Yeah,
And when we
yeah.
talk about, like, can they forgive, can they at least
Student loan.
forgive treasury debt, for example, or government debt? Well, banks around the world hold trillions of dollars of this treasury debt. You can't wipe
Yeah.
out the assets of all the banks that we have. Right there, that's sort of a non-starter. No, I don't believe in this great reset. I mean, the situation is obviously unsustainable, but it's not unsustainable in the sense that we're going to explode tomorrow. What this really is I hope I have these charts here. Bear with me. This is GDP per capita. This is in nominal terms. This is including inflation. This is a very, very long-term moving average of economic growth. All that's going to happen with this debt burden that we're building up that continues to go higher is that we're going to continue to grind towards lower and lower and lower rates of
Growth.
economic growth. That's
Yeah.
in nominal terms, and I guess I don't have the chart in real terms in this pack here, but it's also moving to the downside. So no, I don't think this great reset is a possibility. I am concerned about central bank digital currencies. I mean, things like that would change the structure of the monetary and economic system at which we operate. That could cause some serious chaos. So I would
Yeah.
be concerned
It'd be a
about
new
that.
credit system, wouldn't it? That'd be like a whole new credit system
Well, it
that you
would
do.
change the way that money is created in the
Yeah.
economy. It would basically render the commercial banking system completely irrelevant because everyone would have bank accounts at the Federal Reserve, rather than bank accounts with the commercial banking system. There would really be no need for the commercial banking system if we were going to go to a digital currency. And I think that the banking system would push back on such a change.
I hope they do.
I hope so too.
I heard that I was talking to a trader friend of mine, and the Bundesbank tested it, and it went pretty well. So they're leaning that way too. So anyway, I'm not a digital fan. Give me cash, bro.
Yeah, that's right.
The war on cash.
Yeah, it's they're trying to figure out more and more ways to engineer negative interest rates, because basically what happens is that this is the total pie here of total public and private debt. This is the whole picture: federal, state, local, household, business, you name it, everything's in here. And the only way the system as we have it can basically hold it together is with ever lower interest rates. And countries around the world are running into this zero lower bound, not just on the policy rate, but on the longer term rates too. We have Germany with negative 10-year bonds, and Japan with negative 10-year bonds, and soon we'll be there in the United States as well. And there's really no way that they can keep the system going as it is without deleveraging, which nobody really wants to do, or pushing the rates lower and lower.
So everyone thinks they're low now, Eric, but you talk to guys like Luke Roman, and in World War II rates were negative 14%.
Real interest rates. Yeah, I have some disagreements with Luke. He's a nice guy. We maybe one time we could hash out.
Oh, that'd be what a great idea.
So yeah, no, he's a nice guy. I'll just leave it at that. We have some disagreements on.
I mean, that's what makes a market.
There you go, right?
And we learn from everybody. And sometimes, like W.D. Gann said, you have to learn how to change your mind, or you won't have any change left.
That's a good one.
So you keep your mind open, and you never know. You could see something one way today and see it differently tomorrow. So we really appreciate you sharing your great work with us, Eric.
Thank you, Dale. Thanks for always having me on.
Yeah, I want to wish you, Merry Christmas, Happy New Year's, and thanks for keeping us in tune with what's happening on a nominal and real basis.
Thanks so much.
Okay, everyone, you got to follow Eric at EPB. And Blake's a fan. Everyone's a fan of the guy, and I discovered you.
Thanks so much, Dale. I appreciate you having me on. And
just call me Colonel Parker, Elvis. Thank you, Eric. Have a great
happy holidays to everyone.
Yeah. All right, buddy.
Bye-bye.
So that's a wrap, everyone. I want to wish everyone good luck with the Fed. Don't get in front of it. React to the reaction, and you could be in the chat room, and I'm sure the guys, there's a session where you're going to be able to be prepped. And then afterwards, there's Eric's Twitter handle. Follow him, and I'll see everyone tomorrow. Good hunting. Thank you, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.